Got a new report, a new note out by the Chief Investment Officer of Cordials Asset Management on Nigeria and the impact of the crude oil prices, particularly I think on Eurobonds. So it'd be interesting to get his thoughts there. There it is, Nigeria, the crude awakening, which is a very clever play on words where crude is rude awakening. All right, and then we're going to get to the NGX performance as well. We're in the last week of the third quarter. There we go. We've got the all-share index up about 30%, and then we've got a number of other indexes. The NGX 30, banking, consumer goods, industrials, insurance, oil and gas. We get into it all. We love this stuff. Arnold Dublin-Green, Chief Investment Officer, Cordials Asset Management. He joins us now. Arnold, it's good to see you again. Good morning.
Good to see you. Thanks
Welcome.
for having me.
Fantastic stuff. So tell us about that. I like that. So crude, what do you mean by the crude awakening? What's that note about?
It's just mainly crude oil and the recent crude oil rally and its effects on Europe bonds in general. I think in general, we've seen crude oil rally massively for the past few months, especially when Saudi Arabia announced taking $1 million barrels per day off the markets, followed by Russia. And for some reason, I didn't see a response or the response I expected in the Nigerian Eurobond market. Historically speaking, really, we've always seen a positive correlation with oil. So oil goes up a few points, the Nigerian bonds trade very well. But I noticed post-global high inflation that there was some sort of weird change in correlation. So correlation went from positive to negative. And it struck me, it made me curious, and I had to look into it to figure out what the main issue was. And the report is just really me breaking down my thoughts on what I think the issue is regarding these bonds and its relation to crude oil prices. And when I think the change, or when I think the bonds will start to translate these positive, should I call it positive oil prices into the bond prices.
I think we can pull up crude oil prices. We do that at the top of the show every morning.
Okay.
What is it good? Is this two sides to the coin for crude oil?
Exactly that.
Yeah. So with crude oil going to 100 possibly.
So it's historically it's been wonderful. Nigeria has always done well. Oil over $100, $120 a barrel. But for some reason, it's negative, right? And it's been negative mainly because, in my perspective, it's been the reduction in our production, our daily production, crude oil production. And we've come to a point, or we were at a point where crude oil production was subpar, less than half, right? And crude oil production less than half, but we're still spending on fuel imports, right? And then you're having a higher inflation environment, you're having crude oil price go up, you're having a strong dollar environment, weaken the naira. Don't forget that crude oil exports account for about 90% or so of our foreign exchange earnings. So naturally, if what makes you foreign exchange or what makes you foreign currency goes low, if you sell less of that, if you export less of that, your naira, your currency will devalue or depreciate. And that's what we've been seeing, right? That's one of the economic effects we've been seeing. But my note is based on the fact that we're now starting to see a little turnaround. The NUPRC released a report in August. We've now gone from less than 1 million barrels a day last year to 1.3 Q1, Q2, and now 1.4, possibly 1.6. So my theory is now it's. I don't want to go as far as to say the bad news is over, the bad times are over. My theory is now that we've seen that turnaround in what we sell, we should start to see a positive correlation in oil prices. And it should really, as soon as the equilibrium, the point of how much we spend on imports to how much we sell, as soon as we get that change, then we should start seeing a positive correlation again. Great note.
So Nigeria just has to pump more oil. That's
basically, in other words.
Pump more oil. Let's get to the NGX. I guess looking at the performance there was a bit of a pullback last week. What was that? Is it profit taking or what?
It's a bit of profit taking. I mean, the NGX is done with 30-something percent, 31% or so year to date. I did a note on that a couple of weeks ago, and my view on that is...
You were bullish, right?
I was very bullish. My view on that is inflation, and I'm still bullish. Right? My view on that is inflation. Naturally, if you look historically at Nigerian equity prices, and my note is more comparing equity to fixed income, by the way, but if you look at it, low inflation, what we call low inflation, 8 to 10% inflation, right? So historically, low inflation periods, you sort of get an outperformance of fixed income versus equities. And now we started to get into a globally high inflation environment and locally high inflation environment. So what you see is you naturally see, bond yields are doing what they're doing, but sort of staying the same. So you're now going from positive real rates to negative real rates. So what happens is equities sort of act as an inflation buffer, inflation protection.
Okay.
So we've seen a 24, 25% inflation this year, and then we're seeing an outperformance on the equity side. My view is as long as inflation continues to stay high, we will continue to see equities do well. We continue to see financial services do well. We'll continue to see perhaps commodity companies do well, perhaps. Consumer staples are a bit dodgy because some can pass it on to consumers, some can't.
Yeah.
And then because of the effects play in consumer staples, they all announce a loss in the first half of this year.
Right.
So because the effects play is a bit tough on consumers, but really and truly, all in all, my view on the equity rally, apart from it being a positive impact, a positive move on the new administration, is also a good inflation play.
Okay. So if we look at some of the sectors, you've already mentioned financial services. I think that's second or third best performer as far as index. Tier 1, Tier 2 banks. Is there what you like, a mix of both?
A mix of both. I like Tier 1 banks. All in all, Zen and GT, I'm quite positive on those. Access Bank released results over the weekend. A lot of banks got rated based on the revaluation, the effects long dollar position. Access didn't really have as much as the other Tier 1 banks, but I still like Access. You have your First Bank with some shareholder issues there, so I'll hold back on that and wait to see how that plays out. Tier 2, I like Fidelity. Fidelity is good. They were suppressed a little bit due to the acquisition of Union Bank in the UK. I think that should be over soon, and you should see a laggard or an oversold stock in that sector. You should see it start to perform.
Another sector, I guess, consumer goods is interesting because it's still up, what, 85%? Is that a rising tide lifting all boats? Because there's inflation play and other stuff. So what's...
I think you use the word rising tide lifting all boats. I think that consumers aren't supposed to be really moving up because they're struggling to pass on this inflation, that this affects losses onto customers, right? But then you're seeing, should I call it good news with Dank Sugar and Nascon, and that's sort of the play right now. So everyone's playing that acquisition, that merger. Let's use the word merger because not really an acquisition. Let's use the word merger. Playing that merger, and everyone's trying to figure out what the price is, where's the price, what's in the price. And then what happens is, BUA food goes up and everyone else goes up. But really and truly, fundamentally speaking, a lot of these guys reported losses in the first half of this year. So it's more, for me, in my view, is more an acquisition play and taking advantage of the unknown in the acquisitions.
What else we got? I should oil and gas. Let me ask you about that because that I think is the best performer on the indexes. So 100%. Is that fuel subsidies and downstream?
It is fuel subsidies and downstream, but that should be a negative impact. You see, but oil and gas is I'm not sure. Owando and E&I diversifying, and again, it's one of those situations where we don't know what's in the price. Right? We're not sure what's going on. Well, maybe the market was tired of negative news and bad news, and everyone just buys into it. So E&I announced that they were going to diversify OML 60 to 63 to Owando.
It's still up in the air.
It's still up in the air. It's still up in the air. That's what we're seeing now. But the market is starting to price it, you see, because Owando down maybe 9% on Friday, pulled the market down a bit, down maybe 9.8% today as well, put the market down a bit. For me, if I were to play oil and gas, I would like the Seplats, I would like the guys who are the oil producers. Because of the good news all in oil, and because of Nigeria announced, NUPRC announced the final repair of the Focado in August, which has boosted production. And we've seen a bit of boost in Bonny, a bit of boost in Kwaibo as well, apart from the brass, which is what A&I is selling. Issues are still there. But oil and gas, I'll step back to see what happens, how this plays out first.
Okay. What about industrials? Like it's funny that they're down month to date, almost 4%, but I think they're up double digits, 14%, but not as well as all the others. Well, what's happening with? Do you like industrials?
Industrials are a weird one for me because now you have the Minister of Works come out to say that contractors are complaining about cement prices.
Mr. Omahi,
exactly, and that really is a negative impact, right? Because that means revenue should go down because revenue times volume, price times volume equals revenue. Revenue should go down because prices go down. So it's a weird place to see this rally. And another one again for me, and I hate to say this, it's a wait and see how that plays out. For me, I'm bullish financial services. I think that plays out well.
Any word on insurance? There's a lot of talk about insurance. There's so many tiny little players there, and they need to be more, mergers. What's your view on insurance?
It's going through a reform right now, right? So the insurance regulator is whispers about a reform. Coronation might be selling or delisting from the NSE. Insurance, if we're seeing a move on insurance, it's just a move on equities as a whole.
Right.
So for me, what you've seen in the equities market is a macro play. It's I can't buy fixed income because yields should go up, and if yields go up, prices go down, and in the market to market, my fixed income book goes down.
Okay.
So what am I going to do? I'm going to rotate out of fixed income into equities.
Sweet. All right. So what does you guys got some funds at Cordros. What does a balanced portfolio look like? People want to make money.
A good portfolio would be to look for a portfolio manager that has a few funds listed, right? So money market fund that gives you a short-term perspective, less than a year. You might want to beat inflation with that, but you have a 3-month to 6-month outlook. You're getting some good yield on that. You go into that. You have a balanced fund that gives you a 1 to 3 year outlook, right? Because the balance comes with 50% equities or some equities, and then a protection of the downside on your fixed income book, right? So you want to have a 1 to 3 year perspective on that, right? And then you have a fixed income fund with a much longer outlook, because now we're in a high inflation environment. Fixed income market might not necessarily be the best play now, but you still need to have some fixed income exposure, right?
That's like bonds, right?
Exactly, bond exposure. So I'd say maybe 40% money markets, 30% balance. Another 20 in fixed income, and then you also need
that's 90. So about 10 now
exactly.
remaining in equities.
You also need a dollar.
Aha!
Hedge.
There we go.
You also need a dollar hedge.
You preempted my next question. Purchasing power.
You need a dollar hedge. Unfortunately, you need a dollar hedge. I hate to sell dollars, but you need a dollar hedge.
Yeah.
Because we are in an environment where the dollar's weak. Continues to get weak.
The Naira is weak.
The Naira is weak, rather. The dollar is very strong. Thanks for correcting me.
Yes.
And will continue to get weak. Although, in my theory, crude oil production boosting or looking better should. I don't want to use the word stabilize, but should in the medium term give the Naira a little bit of a level.
Yeah.
I still think that one needs to protect themselves.
Right.
And so you should be looking for a fund manager. With a
Cordros asset
manager with a dollar fund.
Look, as we talk about all these, inflation is a headwind here, is it not?
Yeah, it is.
So the risk there is you're trying to can you, if you look at dividend yields, returns on fixed income, returns on equities, plus dividends, can you beat inflation? Is it possible?
I mean, right now you probably can. Equities is doing very well. You have some of these guys paying good dividends out there. Money markets, I'll say more on the equity play. I'll say equities. I said it at the start of the show. Equity is a good inflation play right now as we see it. Another good inflation play could be a dollar fund, right? Because in a dollar fund, a dollar's cash still fights against U.S. inflation, right? But a dollar fund that invests in Nigerian Eurobonds or Pan-African Eurobonds, you get high yields of 9 to 11% on some of these papers, right? And the corporate Eurobonds as well, you're getting 13, 14% of some of these papers.
Wow.
So having a dollar fund helps you beat inflation both locally and globally.
Right. Nice. And what's your outlook? I mean, we're almost at the end of the year.
Yeah.
What do you for Q4? Do we just coast to the end of the year? Is there a Santa rally coming up? How do you see?
I think equities still play well.
Yeah.
I think fixed income watch the space. I think fixed income yields go higher, so you might want to step back from fixed income into Q1. I think that we should hopefully have some sort of mop up of liquidity, which means rates should go up. So you should have a rise in yield. So I'll say step back from fixed income a little bit, load up on your equities and load up on your dollars.
And as far as the new year is concerned, 2024, I know we still have a lot of reforms as far as goes. Do you think we'll get I know next year is very far. Do you think we'll get a better year in 2024 than? Sorry, you know what? Scrap that question.
Okay.
No, sorry. If we foreign investors have had issues with getting their funds out, so I think we're seeing more domestic investors than foreign.
Yeah.
Does the market pick up if we fix the FX situation and more foreign investors come back to the NGF? That was my question.
The short answer is yes.
Short answer is yes. Arnold Dublin-Green, Chief Investment Officer, Cordros Asset Management. Thank you so much for joining us. You got to come back. We got to bring you back often to talk about the markets. Thanks for the breakdown.
Appreciate it. Thank you.